This is what we call low-hanging fruits. How do we harvest low-hanging fruits in an exam? Trust you me, advanced financial management really is not all about number crunching. I'm yet to see the students who are studying with us at RCM having discussions where in this case here, they, for example, say that today we are discussing theories. Today we are discussing theories. All of us simply think that AFM is all about number crunching, and yet, if you look at your past papers, you'll be surprised about 35 to 40% of your total marks come from theoretical areas. And I would want us to look at September 2021, September 2021. September 2021. Is there somebody who has been able to get that paper? September 2021. September 2021. Once you get it, could you kindly put up your hands like this? September 2021, quite a great paper. So if you try counting those marks, you'll bear witness with me that, hey, I mean, students end up passing AFM by just knowing like theories alone. Yet it's possible. Because if you score like 35% from the theoretical areas, then automatically you're done. You're done. And some of the questions really that come over here are very, very basic. Very, very basic. Like I would want us to look at question number 2. Question number 2, Roman 3. 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 So question number 2, Roman 3, told us to highlight 3 minimum requirements that one must fulfill in order to qualify for a mortgage in real estate financing. You don't need to have gone to anybody's class for you to be able to answer this kind of a question. Ladies and gentlemen, of course, one of the conditions that you must meet for us to be able to give you a loan facility to buy like a house. Like I remember when I was buying my own place, all right, through a mortgage, these guys would want to know your ability to pay. So they would want, in this case, if you are employed, to see your pay slips, not 1 month's pay slip, not 2. They can even ask for 3 or even 1 year's pay slips. And of course, once they get your pay slip, they are basically looking at what we call the debt to income ratio. Assuming in this case here, you have a net income of say 500,000. But in this case here, 300,000 goes to debt. So 500,000 is your income, but debt is 300,000. So if you take 300,000 over 500,000, then automatically you are highly geared. Your debt to income ratio is very high. There is no mortgage lending institution that will be able to advance a mortgage facility to you. If in this case here, your debt to income ratio is more than 50%, they don't want to work with a third there. Because mortgage is long-term and there remain risks which come along. So they'd want in this case here to give you money if your debt to income ratio is less than what here, 50%. So your ability to pay, we have that debt to income ratio is very, very important. Ladies and gentlemen, there is no mortgage financing company that can give you any money if, for instance, you are listed in any CRB. So your credit history is so important. Credit history is so important. Now, what else? What else? If you look at the answers given here, so I'm just going through very fast. So we have a good credit score. We have stable income through the pay slips you give us. They will always need a down payment. Like most of these companies will tell you 10%, depending on your employer. If you're working for government, 10% down payment will easily give you, in this case here, a mortgage loan facility. Then we have your debt to income ratio. Already I've explained that. We have the concept of property appraisal. And then lastly, you can't be given a mortgage if you don't have it insured. All mortgages are normally insured. All mortgages are normally insured. So is that okay, ladies and gentlemen? Can I go to the next, it's just a high level. I'm just trying to widen your thoughts regarding these theoretical areas. So can I go to the next question very fast? Is that good enough, or is there anybody who has a question? Thank you very much. And then I would want us to look at still the same, but this time round Roman 1. Roman 1, September 2021, question 2, Roman 1, they wanted us to do something very easy. Roman 1, identify 3 types of primary mortgage lenders that are likely to benefit from the mortgage refinancing facility in your country. Mortgage refinancing facilities, like in Kenya, here we have the Kenya Mortgage Refinancing Corporation. What do these refinancing mortgages company do? What they do, ladies and gentlemen, is to ensure that we have enough liquidity in the market to facilitate mortgages, to ensure that mortgages come to the end successfully. Remember, when we talk of refinancing, it means that this is an individual, Joshua Ura, who had been given a mortgage of, say, 30 million Kenya shillings. In between here, Joshua Ura may start struggling. So it's always important for you to say, instead of you being tied up at Equity Bank that you believe, for example, is very expensive, do we have any other refinancier who can come and buy this mortgage from Equity Bank? So we talk of refinancing. So you can transfer this property of yours to a different company, different bank, preferably like now the Kenya Mortgage Refinancing Company, all right? And then they pay Equity Bank off. One of the advantages of this refinancing, ladies and gentlemen, is that even Equity itself, when it gives a lot of money to mortgagee, all right, when it gives out a lot of loans outside, it could also be struggling. So in this case here, they would rather have somebody in this case here who comes and pumps in money to them, and then they can keep on creating new mortgages, etc. So then when we talk of primary lenders that will be able to benefit out of us having a well-working refinancing mortgage bank, of course, the SACCOs. SACCOs are in these mortgage businesses. These guys here will be able to benefit mostly because now they shall be able to get cash. Remember, they had advanced mortgage money outside there. So this refinancing bank will give them cash. And then, of course, they'll be able to earn more fees by advancing the same cash to other people. Because, you know, originating a mortgage is a costly thing. To them is an income. So if we can get somebody who will be buying off these mortgages, and then we create some other pool of money, which we shall be using, ladies and gentlemen, in this case here to advance outside there, then automatically that is very good. So SACCOs will be able to benefit. These mortgage refinancing companies themselves, they'll be able to benefit because they're also in business. Banks, the traditional banks will be able to benefit because every time in this case here, a refinancier comes and takes up a mortgage, of course, this refinancier, they are buying off, there will be some income to these guys. And they'll be also getting more money to advance. So then even the brokers in between, there are brokers in between because now once these refinancial companies come and they've given us money, then automatically, like now, Equity Bank will be able to tell these brokers, hey, now you guys look for people to give these mortgages. All right. Now, ladies and gentlemen, I'll be able to share this with you and then read pretty fast. So mortgage refinancing companies can benefit various types of primary mortgage lenders. When borrowers refinance their mortgages, they pay off their existing loans and take out new ones with more favorable terms. This process can create opportunities for different types of lenders. Some primary mortgage lenders that benefit from mortgage refinancing companies include, we have banks. The traditional banks, we are told here, traditional banks are one of the most common types of primary mortgage lenders. When borrowers refinance their mortgages, banks have the chance to provide now new loans and earn interest and fees on these new transactions. That's how they benefit. Now they have money being returned to them. And then in this case here, they lend out afresh to other guys who want mortgages. So they'll be able to earn, in this case here, interest from new loans. They'll be able to also earn fees, etc. Number two, the SACCOs, same explanation. Then we have these mortgage companies, non-bank mortgage companies, also known as mortgage lenders or mortgage originators, specialized in providing mortgage loans. When borrowers refinance through these companies, they have the opportunity to originate new loans as well and earn revenue through interest and water fees. Then we have government agencies, such as now National Housing Corporation. Of course, in this case, if you have a mortgage or rather you bought a property from National Housing Corporation, all right, through a mortgage, and then you refinance. Of course, these guys are happy. It's much better to have mortgages refinanced than the same mortgages being defaulted. So government agencies such as National Housing Corporation they also have mortgage programs with specific financing options. When borrowers refinance through these programs, it can help support home ownership initiatives, because of course that is the major goal of these guys, and create lending activity for the government agencies. They also earn something. Then we have the mortgage brokers. Mortgage brokers act as intermediaries between borrowers and lenders, helping borrowers find suitable loans. When borrowers refinance through mortgage brokers, it can lead to new loan originations for the lenders they work with. Now, ladies and gentlemen, if you allow me, I'll be able to go to September 2021, question number 4. In September 2021, question number 4, they wanted us, if you look at that question, AFM question, September question number 4, they wanted us to do two things for 6 marks. They wanted us to explain the meaning of the term Eurobond, and then number 2, discuss 4 benefits of Eurobond financing. Ladies and gentlemen, first of all, it will be important for us to know that a bond is a financial instrument that companies, in this case here, governments can use to borrow. When you borrow, you will give the people who give you money, you will give them some document which shows that you owe them. That's what we call a bond. So in this case here, that bond, that particular contract is what binds them to you. It's a proof on their side. So when you talk of Eurobond, now these are papers not given to Europeans. No. These are basically financial instruments or contracts that are given to foreigners. That companies, for example, in Kenya here, or Kenya government, for example, could use to borrow from foreign countries. So the most important thing, whenever they talk of Eurobond, don't confuse with Europe, but of course you can use Europe here to appreciate that basically we are using these Eurobonds to borrow from outside there. So meaning that we shall be getting loans which are denominated in other currencies. So I'm reading here very fast. A Eurobond is a type of bond that is issued and traded in a foreign country's market, but denominated in a currency other than the Kenya shilling, for example, other than the domestic currency of the issuing country. The term euro does not refer specifically to the currency of the Eurozone, the euro, but rather to the fact that it is issued outside the domestic market. It's issued outside there. For example, if a non-European country, let's say Japan, issues a bond denominated in euros and sells it in Europe, it would be simply a Eurobond. Similarly, if a European country issues a bond in US dollars and sells in the US market, it will also be categorized as a Eurobond. Listen, this thing should not confuse you at all. When we talk of euro means what here? Outside. You've issued these contracts to foreigners outside there, and therefore you're going to get loans from outside countries. Remember, like the Eurobond, which was issued in 2014, which is now due to mature in 2024, next year, which is really bringing a lot of shocks to this great country here. They issued Eurobonds to 3 different countries. They issued Eurobonds to US, Britain, and Germany. And they were able to get, ladies and gentlemen, money in 3 different currencies. So euro means outside. So I would want to get, in this case here, some confirmation whether we are together. Are you guys able to understand what I'm talking about? If you're able to understand, could you kindly mention there why for yes? And as you mentioned that, I would want to take this opportunity to welcome all these students who are here. I know most of you are not my students. Please choose to do block release with us. Choose to study block release with us online for Kenya shillings 2,000 only. And if you're interested, then please give us a call like today, 0793 555 000. I'm repeating again, 0793 555 000. Great. Now, ladies and gentlemen, we shall read here. Now then, what are the advantages? What are the advantages of issuing a Euro bond? Now, ladies and gentlemen, advantages of issuing a Euro bond, advantages of borrowing from outside there using this Euro bond. Number one, the things that I will never forget, it is the lowering of cost of borrowing. Remember, outside the countries like US will easily give you great money, in this case here at a very low rate of interest, like 3%. Great. Number two, the one that I will also never ever forget is the concept of risk management. Diversity of your foreign currencies. Very stable countries, in this case here, will not have a lot of what here, like Kenya shillings in the, no. We're supposed to have like all currencies if possible around here, because we are doing trade with the various types of what here countries. I would want a situation when I'm in Kenya and I'm doing, for example, trade in Uganda. You tell them even before you sell as Uganda, Kenya shillings or whichever, we have some Uganda shillings with us. We're going to pay you. So in this case here, we have that concept of diversification of the foreign types of foreign currencies that you have in your country. Ladies and gentlemen, we also have the concept of accessing, being able to access international markets. There is nothing as good as having a country that is able to borrow internationally. I mean, your reputation goes up. If, for example, today, you look at today's standard here, they are talking of Kenya credit rating takes a blow after Fitch review. Prospects of accessing cheap loans were deemed after the credit rating was revised to negative. Of course, in this case here, assuming, ladies and gentlemen, that the Kenya government was able to pay its Eurobonds in good time, then we would be getting a positive review. All right. And when you get a positive review by some of these international companies that are score countries like the Moody's, etc. Fitch is a great one here. So like now, currently, all these companies have given us a negative credit rating. All right. So negative publicity. However, if you're to be in the position of paying our international loan obligations nicely, then automatically would be getting what here? Great image outside there. Every other country would want to work with us, All right. So the points are here. We are saying here diversification of investor base. Eurobonds allow issuers to tap into a broader and more diverse pool of investors in international markets. This can help reduce dependence on domestic investors and mitigate risks associated with the changes in local market conditions. Ladies and gentlemen, remember, when you go borrowing outside there, you are basically leaving whatever monies that banks have locally for domestic consumers. This is one of the surest ways of even lowering the local rate of interest. Because there is nothing as bad as governments, like now what is happening today, when we have a government that is fighting with the locals, domestic borrowers here. We fight for the little money that is here. Automatically banks will raise up. Like now you can imagine, just last week, the government announced treasury bonds, all right, infrastructure treasury bonds at 16.8%. At 16.8%. So banks then will be torn in between the lines. Do we give this money to the government at 16.8% or we give it to these private companies? No, they would rather give government. If a private guy wants, I will have to add like 10% on top of what I will advance this money to government. Okay, great. Now, ladies and gentlemen, in this case here, we are studying here. So access to international capital by issuing Eurobonds, governments, corporations, and other entities can access international capital at potentially more favorable terms and interest rates in their domestic markets here. Currency risk management, of course, you've got many types of currencies. Lowering borrowing costs, yes. We have number 5, I've also discussed number 5, enhanced reputation. Then we have the concept of liquidity, and this is what really makes these Eurobonds to be very strong. Eurobonds often benefit from higher liquidity due to access to a larger and more active international market. This liquidity can make it easier for investors to buy and sell these bonds, enhancing their attractiveness. Now listen, now that, for example, Kenya is being rated very negatively internationally, now, most of those investors who had given us money outside there, they can go to international markets. And when they're in these international markets, they'll be able to sell. So they are liquid. It's not like just a bank loan, for example, like how Kenya Airways was given money by Equity Bank, and it was not able to pay. So if it was not able to pay, what happened? Of course, those banks were given what? Yeah, shares instead of loans. So we're saying that Eurobonds are very nice because they are trading outside there, so they are liquid. So myself, as an issuer of money, if I've given out a loan to you, should I have some problem in between here, just like shares, I can go and sell this Eurobond. So that really makes these bonds attractive, and that is why they are normally subscribed like 100%. It will be very hard for you to get Eurobonds that are unsubscribed. Now, ladies and gentlemen, we have diversification for investors. We have already mentioned this. It's important for you to diversify your investors. Very important. Don't rely on just home investors. And we are saying something very important here, that despite these benefits, Eurobond financing also comes with some risks and challenges. Fluctuations in exchange rates between the issuer's currency and the bond's denomination currency can affect the overall cost of borrowing. Additionally, geopolitical and economic conditions in both the issuer's countries and the currency's country can influence investor confidence and the bond prices. Ladies and gentlemen, please listen and listen to me very well. Like when Kenya, this is a very good story that I would want you guys to go and read on page number 9 of the Standard. When Kenya was borrowing its first Eurobond, $2 million US, a dollar was exchanging at about 104. A dollar to buy a dollar that time. It was 104 Kenya shillings to $1. Today, a dollar is going at 142. So about an increase of about averagely 50%. So you can imagine here you are paying your normal interest rates, but when it comes to redemption, you will have to part. You'll not be able, these guys are talking over us paying about, instead of 2 billion, you shall be paying about 3 billion. US dollars. It's huge money. I don't know where you're to be able to get this money from. These are very big headache. All right, very, very big headache. And remember now, those Eurobonds are not, there are like 3 of them, actually 4 of them, which are now falling in place quite fast, successfully after each other. So we're saying that the biggest disadvantage of this Eurobonds, never forget this, it is the concept of what here, the exchange losses that you may make because of the instability of your currency, home currency. The loan may end up being what here, very expensive. And then remember, most of the issuers of these loans would always want to be paid back in what year? In the dollar, using dollars. All right, so that automatically brings shocks. Like right now, I mean, come next year, I mean, a dollar could easily be going for 180, because now, ladies and gentlemen, these Euro bonds are falling due. Then we have this other thing that we got into trouble. We took ourselves there, the fuel thing, importing fuel from Saudi Arabia. Today again, if you look at, is it today? Today's Business Daily, I think. Business Daily. No, it's here. Fresh dollar crisis looms on fuel bill. The fuel that we took right now, it has hit 500 billion. And the government, unfortunately, we were getting this money, and the motorists were paying for fuel in cash, but ourselves in this case, I don't know where that money goes to. Now it has reached a point where you're supposed to be paying the money is not there. It's a crisis. Now we're trying to send people to Saudi Arabia to go and negotiate with Saudi Arabian government. They've refused. They need their money. Great. So we go back here, ladies and gentlemen. This is very interesting, and I'm taking more time to basically help you. So September 2021, question number 2, Roman 2. Don't worry about how I'm arranging them. So Roman 2, the issue of refinancing. So in this case here, they wanted as a question 2, Roman 2, summarize 3 objectives of a mortgage refinancing company in an economy. So of course, in an economy, ladies and gentlemen, like myself, I refinanced my mortgage one time. And one of the things in this case that made me to refinance is because I got a refinancier who was asking for something smaller in terms of interest rates. So objective, of course, number 1 is to help these mortgage owners. The mortgage owners, they reduce their rates of interest. Is to help their mortgage owners not to default on their loans by increasing the number of increasing the duration. They also enhance liquidity in the market. They enhance liquidity in the market by ensuring that these mortgage guys, as they're struggling, they come in and help the market, because if this guy struggles and he goes down, the bank is not in the market of or the business of selling houses. The bank will also struggle. Auctioning process is not an easy thing. So we'd want, in this case, these mortgage people to be facilitated for liquidity to be there. Ladies and gentlemen, when they tell you to give them an objective, or rather objective of any company, remember these are just your normal companies. They're also profit-making companies. They have an objective of maximizing their profitability, an objective of increasing their market share, etc. So, ladies and gentlemen, here, they are here. These are the things here, the objectives. Assisting borrowers. The main objective of a mortgage refinancing company is to help borrowers refinancing their existing mortgages. This involves providing borrowers with information about refinancing options, guiding them through the application process, and offering competitive mortgage terms that align with their financial goals. Lowering borrowers' interest rates. One of the key benefits of a mortgage refinancing is the potential to secure a lower interest rate. Improving loan terms. In addition to lower interest rates, mortgage refinancing can also allow borrowers to change other terms, such as loan duration, etc. Enhancing the borrower's financial stability, because some of these loans can really choke you up. By refinancing to better terms, borrowers may experience improved financial stability and reduced financial stress. Increasing their market share, don't have to really belabor on that. Number 6, maximizing profits. I also don't have to belabor on that. And then we go to September 2021, question number 1A. Question number 1A. So I want to believe I've been able to broaden your mind a little bit on that area. So can I go to the next question? Can I go to the next question? Can I go to the next question? You know, there are theories of AFM. If you don't understand them, you'll always keep on. Amoth is saying that I'm very fast. Amoth is saying that I'm very fast. It's because I really want to finish like the entire paper. So long as you're able to understand, and again, the video will be given to you, you can pause it, you can tick it. What do you think? Is there somebody who is trying to take notes? Please don't take notes. Remember, I'll give you the handout. Remember, I'll give you the handout. For me, it's about broadening. It's about broadening your mind. It's about broadening your mind. But if you're trying, in this case, to take notes, then this really is not your class. Great. Great. Okay. So I think the issue of speed is there. Okay, great. It's called helicopter. When do you it's called helicopter, yes. Helicopter ni juu. Ukisikia Eurobond at least. Remove pin. Great. Okay. Great. Now, so come here. So they wanted us in question number 1 to talk about the shortcomings of the modern portfolio theory. So I'll be able to answer this one alone because of speed. I'll be able to answer this one alone. Modern portfolio theory. Now, so remember that a portfolio is a combination of investments. A portfolio is a combination of investments. It's wrong. If, for example, today, like I gave you this story, of a friend of mine who, upon retirement from Kenya Airways, was given about 15 million Kenya shillings. And then he went and built a very good apartment. Those days, 15 million could give you like 3 floors of an apartment. After he finished, people came and told him that, you know what, you've planted this house on some riparian land. So they came out with those things that do like this. They basically demolished the entire thing. Your guess is as good as mine. This guy, up to date, he has never recovered out of that trauma. His biggest undoing, his biggest mistake, of course, was putting all his eggs in one basket. Putting all his eggs in one basket. You should never do that. Please spread out your investments. Have some of this money is going to shares. Have some of these monies, and you should never trust. You know, like there is a time people were saying that Safaricom shares are the best. Now people are putting all their monies in Safaricom shares. What is happening today? Apart from the last 2 months, again, they've started going up, but generally they had really gone down. So I would rather in this case here subdivide my money, put some money in this case here in shares, some money in property, some money in government bonds. Like myself, I cannot do without government bonds. Now, as we discuss that, really, this portfolio theory, does it have any shortcomings from that formula? Yes. That formula of getting returns of a portfolio, yes, it has got so many shortcomings. In the interest of time, I'll read them. So we have here, it has very unrealistic assumptions. Modern portfolio theory relies on several assumptions that may not always hold true in real world markets. Some of these assumptions include normality, normal distribution of returns, constant correlations between constant correlations between assets and the existence of a risk-free asset. In reality, asset returns often exhibit non-formal distributions. Correlation can vary significantly over time, and risk-free assets may not be available or may carry other type of risks. Ladies and gentlemen, if you remember the portfolio equation, how we talk over risk-free, if you remember the portfolio risk-free plus. So we're assuming that we have a risk-free asset. This risk-free asset may not be there. That risk-free asset rate is known in advance and will remain constant. LI, even governments in this case here, because of the risks involved, they're increasing that treasury bill rate. All right. We are making an assumption that all investors are risk averse. That's a lie. We have other cadres of investors, others are risk takers. All right. Now, ladies and gentlemen, we are saying something very important here. Even the concept of linearity, it cannot apply throughout. We know that life will always have ups and downs. We are talking of normality. If you remember that, what we call ugali ya mluya, where we have the mean and then we have the standard deviation, that most of these investors will normally cluster around the mean, where we have the peak. That's a lie. Life has got extremes. We have got COVIDs, etc. So most of those assumptions are unrealistic. And that is why the modern portfolio theory doesn't work. Number two, it ignores extreme events, which is very, very true. It assumes normality. MPT does not adequately account for extreme events or tail risks. COVID crisis has demonstrated that the occurrence of extreme market events can have a significant impact on the performance of portfolios. Great. Go to the next one, number three. Inefficient use of historical data, that you're using only historical data to be able to come up with a regression equation for future prediction. That's wrong. The history may not repeat itself in future. Things are very different. MPT relies heavily on historical data to estimate expected returns, volatilities, and correlations. However, historical data may not always be a reliable predictor of future market behavior, especially during periods of structural changes in the economy or financial markets. Then we have number four, the portfolio optimization challenges. Ladies and gentlemen, remember that for us to be able to use portfolio equation very well, we need what we call ERM. Do you remember the ERM? expected return of the market portfolio. We are assuming that we have what we call a market portfolio. A market portfolio is also known as an optimum portfolio. It is the portfolio it is a portfolio which is in the skies up there, best portfolio as compared to the others. All right. So we are making an assumption that we have that kind of a portfolio which of course guarantees you maximum returns throughout. Things change. I mean, who knew the Nakumats, or rather Nakumat, would go down when Nakumat was real Nakumat, when they used to tell us that if you need it, we've got it. Now they're down. Who knew some of these companies like Akamba would go under the bus itself? So there is no way you can tell me that there is a basket of goods up there that will guarantee best at some time. Everything bends, including yourselves. And I always keep on telling you this when I talk about you investing in your retirement. Everything at some point will bend. All right. So optimization. The process of optimizing portfolios according to MPT can be computationally intensive and sensitive to small changes in input. This can lead to potential instability and uncertainty. The best explanation here for portfolio optimization challenges, ladies and gentlemen, is that to get this optimal portfolio is never an easy thing, and it can never really guarantee you the highest returns throughout. No consideration of investor preferences. MPT assumes that all investors are risk averse and solely focused on maximizing returns for a given level of risk. Ladies and gentlemen, this is a lie. We also have what we call the herding. You must have heard of this, herding, where investors it's coming to somebody privately. I need to change this so that I communicate with everybody meeting here. Herding. This one you will get it in your exam. Herding principle. So herding principle basically comes as a result of us having like some kind of a person who is shepherding. So a person in this case here comes and tells you, hey, let's go and buy land in Shakahola. And all of us, we move down there, 1,500. It's called herding principle in finance, where now we shall defy rules of portfolio management, right? We'll not be able to look at other things. They may not make sense, but now we are being forced by our shepherd. It's quite a bad theory in finance, which goes against the rules of demand and supply, which goes against the rules of portfolio theory. All right. So, ladies and gentlemen, we have here lack of granularity in risk management. Modern portfolio theory typically uses only standard deviation. It uses the total deviation as a measure of risk, but it does not differentiate between the types of risks. Remember, it's CAPM. It talks about a systematic risk and systematic risk. All right. This oversimplification can lead to suboptimal portfolio decisions. Ladies and gentlemen, then remember, we have here transaction cost and taxes. We always ignore. This modern portfolio theory always ignores this. And they are very, very important. I mean, when you are buying securities, you must incur a cost. The government would want some cut out of this. And then we have limited focus on qualitative factors. Limited focus on qualitative factors. Limited focus on qualitative factors. Remember, when we go to investment, we are only using, for example, the returns, the shilling. We're using the standard deviations in shillings. So basically, we are making our decisions quantitatively, assuming in this case here that that is, or rather money is the most important thing. Ladies and gentlemen, money is not everything. If there are some mature people here, they'll tell you you would rather cry. No. You would rather be happy on a bicycle. There are qualities, even if a man was to come to you, even if he's a millionaire, there are things which are qualitative in nature, which in this case, even a wise lady should be able to see. You should always be able to, you don't have to look at life from just money. No. It is both quantitative and qualitative. And unfortunately, this modern portfolio theory only considers money as the most important thing. So then, ladies and gentlemen, as I sign off, what have we learned today? When you go back to your employer has been saying, you guys in this particular classroom, what will you be able to tell your employers or your friends that you have been able to study today? Please type something there. So for the students who have just joined us, as I get comments from you, as I get comments from you, I would want to invite all of you to our block release. Block release, yes, block release. We're charging 2,000 shillings per paper. If you're interested, call us 0793 555 000. Once you pay that 2,000, you'll be able to get access to our block release videos. You'll be able to get access to our learning management system. You'll be able to do, in this case here, what you'll be able to do our cuts there. You'll be able to get an experience that you can't get in any other college. Trust you me. Trust you me. Trust you me. Great, great objectives of mortgage refinance companies. Great, great, great. So I'd like to take this opportunity to thank all of you, for having chosen to eat this lunch with me. It's an air burger. It's an air burger. It's an air burger. It's an air burger. And because I can see very good questions coming over there, and I also have a meeting at 2 p.m., please allow me to disappear. As always, I sign off like this. My name is Dr. Joshua Aura. Don't fail to call me. I've already given you my number. Bye. Yes, all subjects, yes, all subjects, all subjects.